Welcome to the Ncast. My name is Rafael DeLeon. I'm the Senior Vice President of Industry Engagement here at Ncontracts. As we get into our Ncast today, what I'm really looking at is most financial institutions have a vendor management program. They have a policy, they have a list, they complete their annual reviews, and they file the documentation. And when an examiner shows up, they can point to all of it. What most of them cannot answer, and I say this from my own experience in examining banks, what they really cannot answer is this: what is your vendor program actually built to do? Not pass an exam, not satisfy a checklist. What is it built to do for your particular institution, for the customers that you serve, and for the strategy that leadership has signed off on? At Ncontracts, we work with financial institutions every day on exactly that question. And what we see consistently is the gap between a third-party risk management program and having one that actually works. It's not a technology problem. It's not a staffing problem. It's a thinking problem. And we help you with those solutions and providing and being able to look through your program and think about it and make your decisions based on that. My guest today is someone who has spent more than 30 years inside that gap, building programs, watching them fail, rebuilding them, eventually writing down what he has learned. Michael Carpenter has worked in the military inside one of the largest financial institutions in the United States and across community banks and credit unions, building risk and compliance programs from scratch. Michael brings a perspective that you don't often find, someone who has operated at scale at the community bank level and can see the difference between a program that performs and one that merely exists. Today, I'll walk us through 4 areas. We're going to talk about an upcoming book. Really, where does this drive come from that Michael has, what he's seen in the industry, and what takeaway that he would like to leave the audience with. So, Michael, welcome to the Ncast.
Hi, Rafael. Thanks for having me.
Yeah, if you could give us a little bit more of your background that I didn't expand upon, if anything that you want to talk about, like what cemented you into third-party risk?
Well, you did a really good job. What hasn't been said? So I actually started my time in the financial institution space in the financial intelligence unit, which really comprised of BSA AML focused responsibilities. I didn't know at that time I was actually involved with lots of vendors. I didn't look at them as vendors, lots of different softwares that we used and applications. And then when I started to move into positions of leadership is when I really started to understand that we needed to manage vendors like people. And then, like you mentioned, going into community banks and kind of owning the third party risk. And then in a community bank, as we all know, if you're at a community bank, you wear so many hats that you start to see the connections and the dominoes so much more clearly. So yeah, I mean, that's really kind of how I got my start in vendor management from the very beginning as an analyst in the BSA AML world, and then eventually owning programs. And then I think also too, what really kind of changed my view of vendor management is recognizing that my message wasn't being received by the audience in the way I expected. So I really kind of leaned in and explored.
Okay. So it sounds like that is kind of one of the main reasons that you sat down to write the book. You really wanted to tell your story in terms of what you've seen. One of the reasons I really enjoy working with you is you are so knowledgeable in the details and the weeds. For me, from my perspective as an examiner, I would come in and look at these programs and evaluate, are they effective? Are they not? Are they working? Are they not? But you've built them from the ground up. And that's the great partnership that you and I have in terms of how we approach these two things. So tell us a little bit more about that.
Yeah. So that is exactly really what motivated me in writing the book was the fact that it looks a lot like theater when we do vendor management. It's like, like you said, as an examiner, you've shared with me over time that, you're looking at program components and then they have to kind of prove that they are addressing those things and doing the actions within. And I think that practitioners, the expectation is that they pass those examinations, right? That they meet the elements of a program. but the needs of the program aren't usually surfaced in just checking and meeting those particular components. And for me, it's like you talked about building from the ground up. When you get an opportunity to own multiple aspects of a business and you understand how that vendor really interacts with a different part of the business, and then you understand that, yeah, the vendor can pose risk, but I need the vendor to perform just period to get this other thing done. And that's where I started talking more about what we're paying the vendor for, not just how we manage the risk posed. And that's what the programs, appropriately so, by the examiners are really focusing on. Like, do you manage the risk as opposed to the organization? Because that, of course, can affect the soundness of the financial industry as a whole over, in aggregate. Yeah, that's kind of why I started the book.
Yeah. So, Michael, what's the title of the book? We've been talking about the book. What's the title?
The Upside of Third-Party Risk Management, a practitioner's guide to turning vendor management into strategic value.
So you were focused on the practitioners for them as you were in their direct seats. You're focusing on them to have these insights and takeaways. Is that correct?
Well, I'm so glad that you asked it like that, Rafael, because I actually am focusing on the C-suite and decision makers, but you are right as well, because I am focusing on the practitioners to think and talk and give information that's useful and meaningful to the C-suite. And then that coupled with the C-suite's awareness of vendor management can actually help us in much more ways than we're actually gaining today. So really it's both, it's top down and bottom up. But the practitioner will probably be the first and most often be the audience and reader.
Right. So the opening of the book really stopped me. You tell the story of a credit union, an approved vendor, a completed program, the reviews were done, and they still ended up with a $17 million penalty and a month-long outage.
Yeah.
If a TPR, third-party risk management program was in place, what went wrong?
I not to be repetitive, Raphael, but it's a little bit of the theater thing, and I say that. I say that lightly and cautiously because there's a lot of people out there, practitioners, and I was one of them, that devote their life. They have pride. They are putting time in. They only can do so much. They only have so many resources, and they're also kind of rising to the expectation. So, not to be a disclaimer, but in that instance that you mentioned, Raphael, that we talk about in the book, if you do the 5 stages of a vendor management life cycle and you meet all those things, you pass an exam and all the risk looks green, looks managed, but you don't understand kind of past the shallow. You start to get into the depth because that's where the meaningful, impactful risk really lies. And as an example of that, not just being kind of like theoretical high level, is a vendor is important to you and you identify the risk as, this is important to my business operations. And if it doesn't exist, then it's going to hurt. And I can even define what that hurt looks like. But then we need to be thinking about, well, but how does that vendor stay up? Do they rely on another vendor? And I've actually read some of your articles on, fourth party risk. I mean, it seems to be like, oh, come on, like, let's be realistic. Like, how many levels can we go? Well, in a risk-based approach, again, with that credit union example, you need to understand what can hurt you and then what can affect the thing that hurts you. And in this case, it's a fourth party outage. And then you get concentration risk. Well, guess what? The FFIEC doesn't really get into detail about concentration risks. And so at the surface level, a program can look strong and it can be like the examiner's not saying anything's wrong. And they're not wrong either because their scope is pretty clear. So then it's like, well, then how did this happen? Because we hit our aim. Our aim was passing the test. We did not aim to have sound business or to have clarity. And so that's how, Raf.
Michael, when you look at how most financial institutions think about their vendor relationship, what's the fundamental mistake they're making?
Yeah, Raphael, your vendors aren't a risk list. They're your operating model. So if your TPRM program doesn't start there, then you're managing the wrong problem.
You hit the nail on the head with that. Tell us a little bit more about that.
It's I feel the repetitive can't stop because it really is meaningful. I believe that if you're just meeting the expectations, and it's a good one, by the way, centralization of all third parties under the general definition of third party is a great start. Um, and then, of course, not to go through the whole, like everything that needs to be done for third party risk management, but if we're just doing those things and we're not um, looking at third party, first looking at what we're trying to accomplish, and then considering how the vendors more specifically help us accomplish those goals of the organization, then we're missing. I mean, again, we're missing the business value. We're missing the business value that comes from this vendor management, like the upside of the vendor management that you conduct. Vendor management, if you don't mind, Raphael, I would say it's managing to win and managing problems. It's not removal of the problem and authority over what must be won. That's management is a very important word in third party risk management, and again, it could be valuable.
I think part of the challenge that most organizations have faced is we've become lulled into this sense of complacency that everything works day in and day out. It works fine. We're not going to have issues. And yet, you worked on that, the operational task team at your institution,
Yeah.
and you see where things go down or where there's slowdowns in responses, and that can affect so many other programs in the institution, and getting a turnaround, on a loan decision made,
Yeah.
anything else. And I think there's that sense of complacency that, well, my vendor is going to perform, and that doesn't happen always every day perfectly. It does not happen perfectly.
That's right. That's right. Yeah, Raphael, when you were saying that, I was thinking about like risk appetite in a way. We don't have to go into detail with that, but like you said, just even in a loan process or even a loan like committee decisioning process, there's lots of third parties that are involved in either one of those. When we don't understand what good looks like, we wouldn't understand or be thinking from an operational perspective what not good looks like, and then what the impact of the not good at scale looks like. Um, and because I remember being in an institution and things would come up every day. We call them putting out the fires, right? Always
Right.
these fires. And it's like, well, I can't track every fire. And this is not me saying, yes, you should write down everything that happens and have a thorough like diary of your day and appropriately organize it. That would be madness. But if you did identify the important things and were able to recognize the things that did matter in aggregate, then it's meaningful. But people don't think of, oh, the ATM's out again, right?
Right.
And that's a vendor problem. But what does that actually cost the business? How many times out until it's material? That's
Right.
the depth. That's not. I mean, it is. It is. It's like, well, it's included in some guidances, but it's not spelled out enough. And I mean, and Rafael, I would say to you, I mean, like examiners, there's only so much scope that they can address. They got
Right.
lots of things to do when they're on site, and they got lots of things to look through. I mean, like, what can we expect from them? You can't expect them to just run your business, right?
No, and I think that's where we're seeing a huge philosophical shift with this administration right now. It is your responsibility at your organization to make sure that you are doing the right things. It should not be up to the regulator to tell you you have to do these list of 20 things. They can provide guidance on those things and give you some suggestions, but it's ultimately how you run your program at your institution.
Yeah, it's. I think you and I were at the ABA. We were talking, and you had made a statement about it's the floor. It is the floor, though. I mean, it's the minimum, and so. And again, not to be overly cautious, but passing exams it's something to recognize and to take a moment and to appreciate, right? And I think that C-suite does appreciate that there's not additional monies that need to be spent in response and meetings and time and another vendor to fix a problem that could have been avoided. So yes, but it's kind of like the C's, right? I
Right.
think that what we're talking about is getting to the B's and the A's where vendor management is truly like a business value.
You use a visualization in the book a closed fist to explain the relationship between strategic goals and risk. Walk our listeners through that because it really is one of those things that's hard to unsee once you've seen it. And this it's a great analogy.
Thanks, Rafael. I smile whenever I get an opportunity to talk about this because I did not know like 5 years ago when I was on a stage somewhere and somebody had asked a question and I just came up with it. And it's just been something that I've referred to a lot. And I was really happy to be able to share it in the book. But yeah, so the closed fist approach. So we've been talking about strategy and people kind of feel like that's pie in the sky, holy grail. We're not going to ever actually get there. But if we start with a fist and we say, let's just talk about what do we want from this product, this service, like this particular campaign, even anything at all. We can go real high level, right? We don't have to boil the ocean for all the good that potentially could happen. We could say the first thing that I want is I want to be fast. Now, eventually, you're going to have to say, like, what does that mean? But you want to be fast. The market data says that in our market, we have an opportunity to get more clients because we can be faster than the rest of the people. Fast, one of them. Two, I want to be available. In the market data, I'm just using this example. It looks like people complain about the hours, and we're set up. We can support it more. We want to be available, and we want to be so fast and available. We want to be accurate, right? These are just pluses. These are the goals. These are the things that are the positives of the goal I'm trying to achieve. I'm going to launch X product, and after reviewing the things, these are these pluses. Now, you're like, okay, but yeah, there's the pluses, but if a risk practitioner will think, well, now I got to come up with the risks. And I used to think early in my career that I needed to find every single risk. That was my job. And a lot of individuals in C-suite, to include this one CEO, he said, can we come up with a top 10 risk assessment? And I was wrong in my response because I'm like, there's just way too many risks. Like, sorry. I should have said, you want to do 5? Because when I take this and I turn it upside down, then the speed is now slow and the up is now downtime and the accuracy is now errors. If you start with that conversation, it's not so overwhelming.
No, right. I think that's great. So I'm going to transition now in terms of, things that have kind of shaped you and your background and having worked with you and understand you, that as close as we work together. I think where you started has really shaped how you look at a lot of operational risk areas, and especially third-party risk. You came into the financial services from the military. What did the experiences teach you in the military about risk that has stayed with you?
I think, and not by accident, there's so many different things that the military kind of instills. And the longer that you're in, you can kind of increase your tool bag of skills. When I got out, I didn't even think about the skills that I received in the military and how they would apply throughout my career. But here's a couple of the things. There was, even if you want to go bottom up, there was this common core type tasks that everybody needed to be able to do, no matter what your job was. Now, okay, yeah, that's easy. There's common tasks. And I learned about slice teams where you can have everybody on this team has to be able to do these basic things, 5 things, 10 things. But then they could be specializations in the other individuals on the team, right? They can all on the team recognize and have faith and confidence that everybody else can do some basic jobs, right? And it really started to help. It kind of gave me an understanding that later when I had to do succession planning that I understood single points of failure and depth and redundancies and all these kind of things, 3 deep redundancies. I didn't think that the military at the time was teaching me about that stuff, but they were, right? And then also too, if we go really, really high, I think about mission essential task list. I remember I was studying for a board. That's the whole, you go to boards in the military and basically it's stressful and they ask a bunch of questions and you got to get them right and you got to hold your composure and all these things. It's the fastest way to explain it. But in preparing for the board, I had to learn about METAL, and it was about the place, the importance of the job at the single soldier to the team or the squad to the platoon to the battery or the company. And you really got an understanding that at this high level, there is this expectation to do something. And I think about like the board. The board has these real high level things, but the teller is going to see that at a bank and say, okay, it may not mean much to them. But if we take those high level goals and then we say, okay, that's the board level goals for the organization, but what about this department? What is this department going to do to help achieve that thing? And there's a whole bunch of different things. There's initiatives and all those things, but then kind of even going back to that closed hand, like, well, what are we trying to achieve? What's the pluses? Who helps with the pluses? This role helps with the pluses. Okay, we're gonna remember that. All right, what's the things that can stop us? What's the hurdles? What's the obstacles? Who helps there? Some vendors, some people, right? And then when you start to get an understanding at this granular level of how ultimately you impact, when I learned metal preparing for that board, I never thought that I would be thinking about that in vendor management and risk management generally. There's a couple of the things, lots of other things I learned that I don't know. I mean, like it just kind of sometimes it just slams into me like a brick wall. I'm like, whoa, like this is I knew this, right? And actually, Raphael, thanks for that question because it makes me think about something that I've been taught for a long time. I think by family members and maybe even friends that a thing that happened in the military, it did relate to something that is happening in banking. And a thing that happened in third party risk management is very similar to the thing in business continuity and very similar. There's a tie to compliance. And I guess I'm just lucky to be able to kind of see those ties quickly. And then I'm just inquisitive. So I lean in.
So I just want to reaffirm when you're talking about metal, it's mission essential task list,
Yes,
correct?
that's right. Yeah.
So again, I think that's just an excellent way to frame it. These things are mission essential. What people do in financial institutions every day is mission essential.
Yeah.
And managing other people's money or holding on to that and the lending that is going on from there. So you built these programs from ground up at the financial institutions, and I talked about it in our opening. When did it stop feeling like it was a compliance obligation and it started to feel like something else, something real? When did that change?
I think the kind of the day or the period when I stopped stopped thinking I was protecting the institution from itself and started started to understand and be it like what are we trying to do? What are we trying to accomplish? Like stop thinking like a risk practitioner. I mean, I said that then. Now I think every risk practitioner needs to be thinking about strategy and goals because what are you managing for to what end? But Raphael, it was the time when I like kind of changed my mindset. What I thought wasn't my job. I'm not in those rooms. I don't make those decisions. It doesn't matter. I just need to know where we're trying to go so that I can communicate in relation to that because that's what people want to talk about. They
Right.
want to talk about what we're trying to achieve, whether it's for a community, for the shareholder, right? Lots of different motivations, but you got to know where we're trying to go to make meaningful what can stop us from getting there.
We talk a lot about vendor selection going wrong. Michael, in your experience, where does it actually break down?
Yeah, if you can't define winning before the contract is signed, then you've lost the evaluation. And I actually just creating some content for some training. I mean, just recently about risk appetite. This is where it really needs to come in, and it really and this is not repeat, but very much related to the things that we've been talking about. Where what am I trying to achieve? And then I look inward at myself and say, okay, what's my part in that? And what don't I do very well? Because that's the things that I'm going to seek for in a partnership. So if you don't know where you're trying to go and you don't know yourself and you pick a vendor, what for what? What are the expectations of them? Like, are they just duplicating the things that I do well? They're just a vendor that addresses the topic at hand, right? Um, so, but that's commonly not always in the room, or at least the vendor practitioners that I speak with, and I'm very fortunate to be able to speak, to many practitioners every year. Um, they're not provided. They don't ask for the goals. And so on an ongoing basis, they're really just, not to be kind of harken back to that first early questions, but they're reporting on where there's data, is it protected, and where we recognized we need them, are they going to be there or be able to recover? So that's kind of like the story all the time, right? And like you said earlier, it's like, well, it's always going to be okay. And if it isn't, what are we going to do about it? Which is probably another topic. But if they need to also include, like, we're paying a lot of money. There's a lot of resources that go in for this partner, right? Are we getting what we need? And you wouldn't know what you need, again, until you know where you're trying to go.
I think one of the clearest examples of where, again, as I asked you the question, what changed for you, and what changed for me over the last 10, 15 years are partnerships. Again, we can talk about it as vendor, we can talk about it as partnerships, we can talk about it as third parties, but partnerships to me is more real. We're in this together.
Mhm.
And where I think most people in the banking, financial services industry really started opening up their eyes was around banking as a service, because again, who we were partnering with.
Yeah.
And so we saw that, a number of institutions jumped into this, and then the regulators came down with enforcement actions. Basically, you're not asking enough questions. You're not asking the right questions.
Right.
And yet, even with those enforcement actions, we saw a huge debacle where individuals lost money through partnerships with that they had, accounts that they had with some of these other partners that were working with financial institutions. So it's now become very real,
Yeah.
I think, in most people in the industry's mind, in terms of, hey, how is this going to impact me or my customers or people that we're working with? Those things really highlighted it and showed us the risks very clearly. It was almost like a slap across the face.
Yeah. Yeah, Raphael, I'm glad you brought that up. It's like I've asked practitioners, especially like if I'm talking to C-suite or even individuals like in the lending area, like, you wouldn't be in a participation loan if you don't know kind of your place in that your first, what position you're in, right? And you think about, like, what does that have to do with third party risk management? Well, it's the same thing. You talked about, like, it was the assumptions made, like, where's my place, right?
Right.
How many people are involved, and what's my place, and what's the process, and a lot of assumptions, because it wasn't there, it wasn't like a depth there. So yeah, I just wanted to, I was told it was kind of insightful that you would never do that over here, but over here we do it all the time.
Right. But it goes back to that point that what the regulators addressed was the floor.
Mm,
Basically, these are questions, and just because they didn't spell out every question you need to ask,
right.
people stop there. Oh, you wanted me to address these, 20 points in a contract or 20 questions as part
Yeah.
of, life cycle management. I did or I didn't. But you're not thinking beyond that to say what else is what is mission essential? How is
Yeah.
that going to affect me and my team and my customers?
Isn't it? I almost would love to hear from you that, I know as a practitioner, sometimes I really appreciated prescriptive direction, you must.
Right.
Sometimes I didn't. So, and third party risk management, like you just said, like, there are certain prescriptive, we're going to check for these things. But yeah, it's like, well, you didn't tell me I had to, but as the business, you have to recognize, what are you trying to achieve, and what's going to hurt us. Let's surface those things, let's be aware of them. Yeah, that I when the prescriptive and not prescriptive, Raphael, as an examiner, uh, do people really, they kind of seek it out, but they also can complain about it.
Right. Well, because the regulator is an easy person to blame, but you have a line in the book that I keep coming back to, and you say the regulator is only there for a short period of time. Explain that and how institutions should be building their programs for the future.
Yeah. Like we said, it is something to to recognize its accomplishment, to have a compliant program and pass an examination. Don't want to take it away from anybody, but that's just part of the story. And so they're only there for a short period of time. I used to call it an open. It's an open book test. Usually no surprises. Like what they're going to look for. And so that really is it. Like there's only so many resources the regulator has. And they usually don't come in, third party risk management is part of two different examinations. And I mean, from a banking side of things, as we know, right? Safety and soundness and on the compliance side, there's a lot of things they address. They don't just come in for vendor management. And even, people are getting more audits on third party risk management. But the scope is the scope. You actually, there's only so much they can look at. But that's what I talk about. There's only so much time. And if your barometer, if your temperature gauge is based on just that score, and we know that it's not everything, then you're kind of making a not fully informed decision on your program sound.
I agree with you. Michael, there's a chapter in this book on controls, and I think what you're going to say is going to surprise a lot of third-party risk management practitioners and compliance and risk officers. Can you give them the headline, what we're talking about when we're talking about controls?
Yeah, you're paying for controls you're not using. That's not a vendor program only. That's a program design problem.
Again, tell us a little bit more about that. Again, we're paying for controls that we're not using. Yeah. Give us a real, down to earth example that people can understand.
And I want to say, Rafael, when I say paying for controls you're not using, you're paying for controls you're not recognizing their use. If I had to kind of restate it. And I get real passionate about this, about all things aren't created equal. I think it's important to start there. So, the things that we do in an organization, and I've heard multiple, guests of your podcast, they talk about people, process, and systems. And hopefully in the industry, that's kind of a known thing, right? This is people that carry out processes that sometimes involve systems, software, vendors, mitigate problems, address the hurdle, address the obstacle, right? Risk. So all things aren't created equal. Like if I have a checklist and then I compare that to an automated thing that doesn't allow something from happening, like a preventative, right? I think we would probably agree that this thing that's automated that doesn't allow the problem at all is going to probably have a more positive impact to mitigate the problem than a checklist. Checklists are usually after the fact, and even if they happened before a decision, it's manual. So this all means, this is the one question I ask, or the one statement I make to institutions. You're not building software. You're not a SaaS company. You even if you build it, you can't manage it, right? You don't maintain it, you don't manage it. So the point is, you're not creating automated controls in your environment. So your vendors are. And another statement I made, and I made this a couple of years ago, when I looked in the audience and I saw a lot of eyes light up. I said, vendors provide the most powerful controls in your environment. First, a lot of the audience, you could see them like, what does that mean? And then I gave them these are really important, powerful controls, and these are not as much in relation. Who's doing these? Automated controls come from vendors. Right. And when you're doing a risk assessment, right, you're like, oh, here's all my controls. We don't know which ones are more powerful than another. At least a lot of institutions don't. And unfortunately, some smaller organizations don't have a lot of resources. They feel it's not important. It's actually more important for them. But when you identify okay, here's a risk. What am I doing about it? Well, I've got some manual things and I've got some automated things. Automated are the most important things. Those are my vendors. So when I'm paying for a vendor, I'm paying for a service. I'm paying for them to mitigate risk that's posed to me, access to data and resiliency recovery, common. But I'm also paying for their power to mitigate the risk to me, right? Which is part of the service. So it's a unique way, I've been told, to kind of think of things, but it's where you can benefit from your risk assessment process and your monitoring of controls in second line to vendor management.
One of the issues that I hear from most practitioners around this topic is we don't know if that control is going to work. So we're building our own versus how do we leverage off of this and make sure it's better. And my analogy is like with the, new assisted cruise control that, adjusts your speed and will even slow down or brake for you.
Yeah,
But you can't just totally rely on that machine. You have to keep your eye on the road and you have to keep your foot near that brake pedal. You're not riding the brake, but ready to like, oh, if that doesn't perform, here's my backup versus I'm going to carry my own anchor around as a brake because I don't trust what the manufacturer built.
that's right. Oh man, I'm so glad you gave that example. And if you don't mind,
Yeah.
I have heard that as well, Raphael. Like people will say, like, well, I'm not sure if that's going to work. So, and they do their own thing, like, right. And that actually, unfortunately, lives a lot. They're paying, but then they're doing something outside. And some of it's like, well, what did your planning process look like, and what did your due diligence look like that you didn't have confidence or had confidence based on not appropriate information? But then and then the other thing is, like I was thinking of compensating controls and the human in the loop, and I love that analogy you gave.
So as we begin to wind this down, if a practitioner or risk or compliance officer at a financial institution puts this book down with one thing that they're going to do differently next week, what do you want that one thing to be? What would your advice be that they should do differently after reading your book and all the things you talk about?
Yeah, I would say first with a risk-based approach in your vendor population. Let's just take a look at what we recognize today as the vendors that pose us the most risk. Let's take advantage of the work that we've done. And for those vendors, or a small population of those vendors, let's make it realistic, right? Apply SMART to the goal that you set. Um, in that population, I start to ask a department. I'd like to understand like your rocks or like the major goals or initiatives that you measure all the work that you do to. Just to get that information. Take it back and connect. What are these vendors? Any of these vendors connect to any of those things? That's your start to your journey of recognizing what we're trying to achieve and the third party that helps support it. And that would be the one thing that if, I think after reading the book, you kind of understand like, well, what do I do with that? And, where do I go with that? And, what do I tell my C-suite and all these things? But if you start with that, I think you'll see and you'll find and you'll start to come up with a lot of things that you already knew. You just put on different glasses on to see it.
Well, Michael, I really appreciate this and you're taking the time to join us today. 30 years of perspective is one thing, but being willing to say out loud what most people want. The program that you built might not be solving the right problem, or it might be solving the wrong problem. And that's something else entirely. And that's what really makes this conversation worth having. The book is The Upside of Third Party Risk Management. So if you work in third party risk management, or if you work as a risk or compliance officer, or even if you're in the C suite, I would urge you to read this. I have gone through and read this from front to back. It is filled with insights and takeaways that you will be able to use as a practitioner, not because it'll give you a checklist, because it'll really make you think very differently about what you're actually building and why. Michael, thanks for being on the Ncast.
My pleasure, Raphael.